Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Diana, great to have you on the show. So we have Diana Mousina, who is the Deputy Chief Economist at AMP. Thank you so much for joining us today.
Thank you for having me. It's lovely to be here.
Thanks, Diana. We'd love to hear a bit about your story and what you do and, your career.
Sure. So I've been working as an economist now for nearly 15 years in the Australian market. I started my career at the Commonwealth Bank as a graduate, and then I moved into the economics team. And I've always loved economics because of really the way that it helps you to understand the world, because you sort of learn to understand why things happen, what the flow of different events is, and it gives you a good grounding to think about politics, finance, markets, and then also how things work in the economy, like inflation and growth and employment. I've been working at AMP for the last 9 years, and my role is really to basically help our clients understand what the current economic environment is and what the future looks like, and also what that means for their investments. So AMP manages superannuation funds basically, and our team sits within the portfolio management teams to help the portfolio managers make long-term investment decisions around asset classes, and economic forecasts and variables are one part of that. And then we also are part of the investment decisions that the portfolio management team does. And the way that we talk about our views is through reports. So my day-to-day is really looking at data that came out overnight in the US, looking at Australian data, making charts, putting together notes for our clients, and doing longer-term research notes as well, and presentations, TV, podcasts like yours to really talk about what AMP's view is on the economy.
So effectively, the data that you're reviewing has a major impact on what AMP's customers or the broader community, or the decisions that they make in their investment portfolios. Would that be correct?
Well, AMP make the investment decisions, I suppose, on behalf of our clients. So the economic variables and forecasts go into that. And then for the broader clients, yes, basically our view helps them to inform them and their teams about what the outlook's likely to be.
Yeah. What I find interesting is every bank has their own forecast, right? We'll come to interest rates and all, and obviously AMP have a view. But moving into the property side of things, the Australian property market. So what's your outlook at this point in time? Where are we going in the property cycles across Australia?
The property market is so multifaceted in Australia at the moment, and it's been an interesting cycle, because you would have thought that all the rate hikes that we would have had, we had 425 basis points or 4.25% worth of rate hikes in Australia. And most economists had the view that that would have created a big downward shift in property prices. Most forecasts were centered around a 15% fall in property prices peak to trough, some even larger. At one stage, we had a view that property prices could even fall by 20% after the pandemic. That didn't end up happening. Prices fell by about 9% peak to trough. And then we had this big boom in price growth at a time that the Reserve Bank was raising rates. And really the key reason why the property market has held up so well in Australia has been two factors. One, we have a massive level of undersupply of homes in this country. We've had too much demand for housing for the last 20 years relative to how much we've been able to supply. And the second reason for the big boom in prices that we've had in the last 2 years has been this big increase to immigration. Now, that's part of also the supply and demand challenge, but the big boom that we've had in immigration in the short term, at a time when supply has been even more constrained in Australia because we just haven't been building enough more recently, has really led to this over demand for homes. And that's led to big increases to rental prices and has pushed people also into the home purchasing market if they haven't been able to get a rental. And also, people have this fear in Australia that they're going to miss out on rising prices, so they want to get into the market. And then you have other factors like the bank of mum and dad who are helping people to buy their homes. I mean, that's I think it is quite a large story for why property prices have continued to hold up, because we do have a lot of baby boomer wealth in this country that goes to children or grandchildren that are then allowed to buy a property that might be bigger than where they would have been able to without that support.
But are you also seeing like people bringing a lot of money from overseas, the immigrants who are also buying locally, or is it generally people who've lived in Australia for a long time?
So with foreign investment into the property market, it is actually only quite a small share of overall sales. We had a peak in about, I'd say 2016, 2017 for foreign investment, maybe a bit earlier than that, when it was a very large share, not a large share, I'd say, a larger share of sales. And at the moment, on some data, it's only worth like 5-6% of overall sales. So the majority of the demand is coming from local investors.
So talking about the various cities across Australia, because every city has their own property cycle, some have been going backwards, others are booming at this point in time or have risen at a fast pace. Say, starting with Perth, right? Like Perth has been rising for a number of years and their rental yields are one of the highest in the country when you compare the capital cities.
Yeah.
So what's your view of where that market is going? Is it nearing its peak or is it going to continue booming?
So usually with capital cities, you do see these, I guess, long-term trends where cities that have underperformed, like Perth was underperforming for years after the collapse of the mining boom, where they had a lot of oversupply and very poor negative price growth for a long time. And now you've seen this resurgence or this renaissance in the Perth market. So capital city markets tend to go through these longer term cycles when things go in and out of fashion, also depending on where the economic environment is there. The resurgence in Perth makes up for a lot of the underperformance that they had after 2012. So partly it's catch up. It's an affordability issue as well, which we can see, people have been moving out of Victoria and New South Wales to move into Western Australia, South Australia, Queensland for affordability reasons, because property is just so much better value there. I think it's a combination of those things. Plus, the immigration story also helps the national market. But I do think Perth is outperforming now because it underperformed for so many years beforehand. It does look like there is more momentum though in the Perth market. I think the factors around affordability are still quite important, and the affordability pressures in Sydney and Melbourne have been so strong in the last few years that it's the affordability pressures, I think, are finally getting the upper hand in the property market, where, in the last 2 years, I would have thought that just the affordability constraint that people have been under, you can borrow 30% less now than you could have before the RBA started raising rates. So that should have played a bigger role in suppressing home price growth in the last few years, and it hasn't. But so it's finally getting that upper hand in cities like Sydney and Melbourne, where prices are basically unaffordable.
So did RBA not succeed at what they were hoping to achieve with these rate rises?
Well, the purpose of the rate rises was always to tame inflation. So back in 2022, we had a peak in inflation here in Australia of 8%, about 8% year on year. Pretty similar across other countries as well. The US had a similar peak in inflation. The Reserve Bank's goal is to get inflation between 2 to 3% over the course of the business cycle. So basically targeting 2.5% inflation. They have succeeded in doing that. I mean, there is still some ways to get inflation a bit lower if you're looking at like underlying or core inflation. Headline inflation has been suppressed by the government giving back some energy rebates and other cost of living relief. So headline inflation is now running at about 2.8% year on year. And underlying or core inflation in Australia is a bit higher still, about 3.5% or so. But the data does change month by month. So it's still elevated. It's above the 3% upper band of the Reserve Bank's target. But we have managed to get inflation down from its peak of 8% back closer to the Reserve Bank's target. So that was their goal always with rate hikes. The Reserve Bank doesn't target home price growth. That's never their mandate. They target inflation and full employment. So basically keeping the unemployment rate as low as they have. And the housing market is sort of a byproduct of whatever happens to interest rates.
So going back to the property cycle side of things, so Perth, I understand it was playing catch up, but will it keep going? Like it seems to have gone strength to strength.
Yeah.
I mean, as buyer's agents, we are finding that there are some opportunities there where we are able to secure properties a little bit easier than what we could, say, 6 to 12 months ago. But do you foresee it continuing to grow in 2025?
I think the outperformers in the new year will be Perth, Adelaide and Brisbane. So basically the same three cities that have been outperforming in the last 6 months, I think will continue from that affordability constraint in the other major capital cities. But I do think that the pace of price growth is going to slow across the country. So while Perth, Adelaide and Brisbane are likely to outperform, I think that the pace of growth will be a bit softer in the new year, despite the fact that we're going to get some rate cuts.
So why do you think that's the case?
Well, when you look at some of the I guess the upper ends of the housing market, so like the upper ranges of sales, some parts of those have started slowing, especially in places like Brisbane. So you can see some weakening momentum, I suppose, in price growth. And I think the same story is going to play out in Perth and South Australia because, in Adelaide really, because basically you still have a market that is overvalued in Australia. So yes, you do have these outperformers, but when you look at affordability metrics, even though we are going to get some rate cuts coming through, I think the affordability story is still quite important for home buyers, and the same pace of home price growth is difficult to be ongoing. I think it's just a little bit unsustainable. Plus, next year we are going to see lower levels of population growth, or basically immigration in Australia, and that immigration has played a big role in keeping demand for home prices elevated. So lower immigration levels, more supply coming onto the market because the government is targeting to increase housing supply. They've done a few different measures to sort of get there. We have seen some lift in things like building approvals and new home sales. So I think the supply story is slowly coming back through. That should ease the pace of price growth next year.
Well, that reminds me, there was an article in Macro Business yesterday with Albert's photo, and it said 1.2 million tents. We are supplying 1.2 million tents for Aussie housing. But looking at, I know you refer to the market slowing down. Brisbane, I think we are already hearing that from agents where it's taking longer for them.
And buyers are being more fussy, even if it's like, say, another $5,000, they're holding back. They're like, well, I don't want to pay even $5,000. But historically, it was like, well, what do we pay to just secure this property? That's a feeling we used to get. So you had to go in strong with offers. But I guess the challenge really is getting good stock. There might be properties, but finding investment grade properties is the challenging part. And Adelaide, right? Adelaide, it's kind of, has its own cycle really from what we understand. It has historically grown at a steady pace versus, say, Perth, which had a bit of a pause from 2012 onwards for about 10 years or so. Where do you see Adelaide going? Like, why is it so popular these days?
Affordability. When you look at the flows of the population into and out of states, they call it interstate migration. You can see that Victoria and New South Wales have had this chronic level of interstate outflows from those regions in the last few years, and it's gotten worse after the pandemic, especially in Victoria, which is partly why you've seen some of the negative price growth in Victoria. What happens is the migrants usually come into Sydney or Melbourne, and then if we're just talking about migration, and then they tend to move out for affordability reasons, and also, local residents as well. And South Australia and Queensland have offered good job opportunities recently. The labour market's been really strong across Australia. South Australia has opportunities in the government sector, and the government has been a big employer in recent years, and the South Australian economy is very much driven by government spending. They've had some more investments in things like defence and also in some of the battery building that's been going on. So there's been more job opportunities there. So people have been moving there for work and affordability. And the same story in southeast Queensland as well.
So Diana, what do you think of the government intervention with the property markets in Victoria, where they've put land tax thresholds, they've put compliance requirements, which are obviously impacting the market, and we're hearing South Australia are implementing similar measures as well?
Well, that's clearly had a big negative impact to the Melbourne market, and just speaking anecdotally to some clients down there and clients of clients, it's put a big restraint on property sales, and that's why it's part of the reason for why I think prices are going backwards there. I mean, the government implemented those to help their deficit issues that the Victorian government is under, and some of those are temporary, but in the short term, I think that there's going to be more downside to Melbourne prices, as well as the fact that I think some parts of Victoria there is an oversupply of stock. When I did some analysis on where there was oversupply or undersupply of housing in Australia, Victoria came out as one of the states that had one of the largest levels of oversupply. Most other states had undersupply of housing, especially in some parts of inner city Melbourne. In the regions, Victoria and Melbourne has done a lot of construction relative to the other states in recent years, and that has led to some of this problem of oversupply.
And looking at, you mentioned that Victorian government wanted to reduce its deficit. However, by the same token, if there's not enough sales, they won't make enough money from stamp duty that they would have otherwise. Do you think they might overturn some of these regulations at some point, because the market has been struggling for some time?
I guess I have to wait and see how much further prices drop. I mean, the drop so far has been small. I mean, it's been noticeable because we don't normally tend to see these this sort of divergence between the capital cities. So depends how much further it goes. Some of the measures are temporary though. And there's been a multitude of different things that the government has announced. Some of them are temporary, so maybe they'll wait and see what happens when the measures are taken out, or maybe they will cancel them eventually. I'm not sure, but I think that prices probably need to fall further before they go down that path.
Really? What is there a prediction or forecast as to how much they might drop further?
I mean, our forecast for Melbourne next year is probably for prices to fall by about 3 to 5% or so on an annual basis. So not really too deep, but obviously still a divergence from the other capital cities.
Well, I was talking to a real estate agent and I just picked up the phone randomly and say, hey, what do you have on your books? We are starting to buy in Melbourne for our clients. And he said, I have 35 properties, and he wouldn't let me go off the phone. And he wanted to actually list out at least 5 deals for me to consider for our clients. So they are getting desperate, but there's a lot of bad stock as well on the market. Like there's a lot of stock, but it's bad stock that you won't necessarily buy. But I guess moving from capital cities, well, Sydney, where do you think Sydney's going? Because when Mona and I were building our portfolio, 2013 is when the markets went crazy. And since 2017, we haven't seen the same level of activity in the market.
I think it's the affordability issue in Sydney. When you look at Sydney as a capital city, on the home value to income ratio, which is sort of a good way to think about affordability, price to income ratios are running at about 12 times in Sydney. So the average price of a home is 12 times your annual income. Now, that's sort of in the range of the most expensive capital cities around the world. So if you compare Sydney to places like Los Angeles, Paris, London, it's in the same ballpark as some of those most expensive capital cities. Not as bad as places like in Hong Kong or in China, which do have very expensive housing in some specific parts. But that just shows you or demonstrates the issue that Sydney has, is that it is just so overvalued, really, and it's become unaffordable for people, even if you're looking at areas that are well outside of the CBD. I thought that's why the government is really trying to expand Sydney City to build up as much as they can But I think that that's really why Sydney has underperformed in the last few years, is just because this affordability constraint is becoming more important for people.
Would it change though? Do you see the boom happening in Sydney again at some point once the rates drop?
Potentially, if rates are dropped by enough. And we've seen a lot of infrastructure in Sydney being built in the last few years. I think that will help as well in terms of broadening out the city and in terms of the government trying to build up as well. But to get an affordable home in Sydney, one that's $1 million or less, that just looks sort of a little bit unattainable.
Mm-hmm. Yeah, you need at least 2.2 million plus to start in Sydney for a house.
Right, and that just how does an average family or an average household make that work?
Yeah.
So then talking about units versus houses, say in Sydney and Melbourne being quite unaffordable in comparison to rest of city, even though Melbourne actually seems better value these days than Perth even. But say looking at units versus houses, do you think units could increase in value in Sydney because of the unaffordability factor?
Well, units have been underperforming houses in this most recent boom that we've had in the last few years. I think people have wanted more space. After the pandemic, they sort of realised, I don't want to live in a unit. Plus, and it's hard to build an affordable unit in the major capital cities for under $1 million. It's sort of, the developers are saying it's not possible anymore. $1 million is sort of the minimum amount that I need to be able to build it. And it goes to the fact that the cost of materials, the cost of labour is so high that even for the developers, they don't want to build unless it's over that amount.
So does that mean that existing apartments in Sydney could start giving better returns over time?
I think so. In the next few years at least, I think that unit price growth is probably going to run a bit hotter than houses, especially in Sydney. But in areas like Brisbane and Perth, Adelaide, I think houses will still be outperforming.
Then regional, right? As buyers agents, Mona and my strategy has been really to focus on capital cities.
Yeah.
But there's a huge talk of data in the property industry. It's the most fashionable thing to look at data these days, right? And people are focusing on regions like mining towns, the Gladstones and surrounds, and even Townsville.
And Rockhampton. A few on Orange, a few of these pockets really. Like how would you, what's your take of this?
I mean, the regions are sort of more difficult, I think, to be convinced of their longer term price growth, or as an economist, when you're sort of thinking about the different drivers of property price growth, I think the regions sort of play to their own tune sometimes, and they are so dominated by sometimes one-off type of events. Like if there's, a new mine that starts being built in a specific town, it can have obviously very big impacts to property prices. When I think about the outlook for mining, though, based on what we see from business investment data, it looks to have improved. Or it looks like it will be improving in the next few years, but we're not going back into periods of a mining boom in Australia. There are definitely still some future growth to mining investment. So places like the cities that you mentioned, I think will still get some demand for housing based on the existing mines that are there and the expansion of them. But I don't see any future potential for regional areas to potentially completely outpace the capital cities.
But then why are people buying in the droves in some of these locations?
It might be an investment instead of buying, in a capital city. Maybe some first-home buyers are thinking, well, I'll buy this as an investment, just get into the housing market, and then I'll be renting in the capital city.
Well, we've seen existing investors also flock to some of these areas because they may be looking for a bit better cash flow side of things. But longer term, in our view anyway, capital growth will outweigh any cash flow, positive cash flow or neutral that you may have in a smaller town. So personally, we prefer capital cities.
I mean, if you're thinking about the longer term growth in Australia, immigration is still going to be incredibly important to this country, and immigrants don't flock to the regions. The problem in Australia is that the regions aren't very well connected to the capital cities. So if we want to get more people moving regionally, we need to build better infrastructure for them to get there. And at the moment, that just doesn't really exist.
And population growth drive some of the capital growth. And if people aren't
Absolutely,
moving
yeah.
to these places, then it's unlikely to see any boom.
Regional growth had an incredible performance over COVID, and that looks more or less over. I mean, people have been forced to go back to the office, and I think that's why we've seen the regions underperform the last year or two.
Yep. Now, I was going to just touch on immigration, really. You spoke about that. So what's the outlook on that?
Yeah.
Are we going to continue seeing as many people arrive in Australia and property markets continue growing as a result?
So in 2023, we basically had about 550,000 new people come into Australia in net terms, so net arrivals minus net departures, because there are always Australians that are leaving as well. Record high in numbers, and in annual terms, it was like 2.6% annual population growth, the highest that we've had since the 1950s. A lot of that was we're playing catch up to the pandemic, basically, because we had zero immigration for 2 years. In the next year, the government's own forecasts are that we're going to get population growth running at closer to 400,000 or so, and that's basically where the data is right now. When you look at the number of people that are arriving in net terms, is running at about 400,000. That's still incredibly high for Australia. The government's put in place some of the student visa caps to reduce the number of students that have been coming in. But the caps are still at pretty high levels. When you compare the number of students that are going to come the next few years relative to before the pandemic, it's still pretty high. Yep. So before the pandemic, our net immigration was running at about 250, maybe close to 300,000 a year. And we're still going to be well over that at 400,000.
It almost doubled per year. Really.
More than that, yeah. I mean, it was a bit of catch up to the pandemic, but those numbers at a time that supply of homes is very constrained is basically the problem that we've had. That it's just pushed people to increase rents.
So we have this unaffordability crisis, which has been around for the last 20 years or so. So why have the immigration levels so high? What's in it for the country?
Well, Australia has always been a country that has had very high levels of immigration, and that's been great for Australia. We're a very multicultural country. I'm an immigrant myself. I've got nothing against migration. I think it is great for the country, and we have needed it as well because our fertility rates have been going down. Our fertility rates, according to the last count, were the lowest that they've been in decades. So countries like Australia that have an aging population, which is very clear, we have an increasing old age dependency ratio, similar to many other advanced economies as well. We need to run high levels of immigration to offset the aging population that we have. Because when you think about long-term growth for an economy, there are three things: population, productivity, and participation. They call it the 3 Ps. So high population growth has been a big positive to get our GDP levels higher in nominal terms. Per person, it looks like a bit of a different story, but immigration is still really important. I just think that for the current time that we're in, when we have this affordability problem in housing, when we have elevated inflation in the country, it does make sense to align housing supply to the levels of immigration a bit closer to make sure that we don't run into problems like the affordability challenge that we have right now.
But apparently, I read somewhere that we need to build 400 plus houses a day to cater for the rising population. That's insane. I don't know if it's even practical.
We need to build about 240,000 homes a year to keep up with our level of demand for homes. And that is also what the government wants to be doing. So the government's National Housing Accord aims to build 1.2 million homes over the next 5 years, which averages out to be about 240,000 homes a year. We're currently building about 175,000 homes a year. So we have this big mismatch between actual levels of supply being online and the demand for them. Plus, not to mention that we've had this undersupply now for years. So we now have this accumulated buildup of housing undersupply. And that just, to me, explains why when you look at home price to income ratios, when you look at housing debt ratios in Australia, why we're always an outperformer. I mean, not really an outperformer in a positive sense, but why we have such elevated housing compared to our peers.
So what does it mean for a potential crash? You know, there's always some talk of, the market will crash at some point.
Always.
And we've been waiting for it for the longest time.
You get economists coming out every single year with predictions of a 20-30% drop in property price in Australia. And I think a lot of those economists are often international economists as well. They come out in a current affair and spook everyone that there's going to be a crash. And I think part of the problem is that people outside of Australia don't understand the specific dynamics of Australia. Australians love housing. It's seen to be a massive asset. We don't have long-term rental agreements here. It was always the great Australian dream to own a home. Australians are good at paying down debt as well. We have offset accounts that allow for people to save and to offset their mortgage with these types of accounts. So we do have some structures in our system that make housing just so much it just makes sense as an asset class for people to purchase into it. Also, we do have tax policies that are favourable towards housing, and we have had that since about the year 2000, which is when we really saw this acceleration in home price growth. Before 2000, home price to income ratios were running at about 4.5 times. So home price was around 4.5 times worth of your annual income. After 2000, that ratio has now doubled to nearly 10. Mm-hmm. And most of the countries, apart from New Zealand and Canada, haven't had the same appreciation in home price to income ratios. So the favourable tax treatments are the capital gains tax discount, the negative gearing tax concession that we have, and also not using the family home in the pension test. So we do have a lot of favourable tax treatments. I'm not saying that one is the specific driver of affordability problem, but I think it's the combination of everything that I've just spoken about that really makes housing a very attractive asset class as an Australian.
Well, talking about negative gearing, there's every few years there's talk of scraping that altogether.
Doesn't look like it's going to happen for next year's election though, because the government sort of floated the idea and no one liked it, as usual.
Well, I guess it had a massive impact on the 2019 election results. Yep. So I don't know if the government would want to tackle it at a time right before the elections as well.
Absolutely. I think the problem with the government talking about negative gearing is basically that people are worried that if you implement this, it's going to lead to a big fall in property prices. Didn't actually address your question before about whether we are going to see a property price crash. And I do want to address that before we talk about negative gearing because I think a crash of 20 or 30% in prices in Australia it's possible. Anything's possible. But I think it's a low probability because you sort of need to see a few factors come into play. You need to see basically a big recession in Australia, a big increase to the unemployment rate, and no government support to get the economy out of that situation. I don't think that that's going to happen because if we do get a recession here or a downturn, I think it's going to be mild because we don't have sort of the excesses, the build-up in parts of the market, like a big build-up investment or a big build-up in consumer spending that would lead to a big contraction or a huge increase to the unemployment rate. I also think that the government would step in if we did go into a big downturn to support the consumer, to support businesses, just like we had during the pandemic. So just because Australia looks overvalued doesn't mean that it's going to crash because you do have a lot of fundamental support for housing and there's reasons for why we look expensive. I also forgot to mention that we have a very high density in the capital cities. So 50% of our population live in 3 capital cities. If you look at other places like the US or the UK, places like London, New York, yes, they are expensive. But when you look outside of those major capital cities, it looks much less expensive, much more affordable. And in countries like Australia, where there is no choice really to move outside of the major capital cities, people are congregated into those regions. So we have less choice to be able to find those more affordable options. And I think that that's also why Australia is a little bit different. So I don't think that we're going to see a 20-30% housing crash. I don't think the government would allow it. And I don't think we have the right economic setup for that actually to happen. It's definitely a possibility, a 5 to 10% possibility in the next 5 to 10 years, but I don't think that it's likely.
Yeah. And what about the current market status? What do you see happening in 2025?
Our view is that national property price growth will run about 5% over the average, over the nation. So that takes into account there will be divergences in capacity performance. So I mentioned before that we think Melbourne will fall by about 3 to 5%. We think Sydney will be up 1 to 2% next year, and that Brisbane, Adelaide and Perth will be outperforming 5 or 6% year on year.
So if there was any property investor wondering if they should start their property portfolio, or what should they do really, right? Like, or maybe should they be waiting for prices to pull back even more? Or like what would your input be to someone who's kind of sitting on the fence?
Well, it depends where they're looking. Are they looking at specific capital cities? And you have to think about the dynamics that are going on in that particular area. With the Reserve Bank likely to cut interest rates next year, I do think it will put a bit of a floor under price growth, because property prices normally tend to do pretty well when the Reserve Bank starts to cut interest rates. I think that the pace of that price growth next year will be a bit softer compared to usual rate cutting cycles, but lower interest rates mean that it will be more affordable people to be taking on property debt again, or to be more comfortable around property prices. So the macro backdrop, I think, is still positive for the property market. I just don't think it's as positive as where it has been the last few years.
So just touching on market resilience, right, as we've spoken that property prices have held up, but how are people actually affording it, like their portfolios? Because, we do cash flows day in, day out. So what's AMP or your outlook on people paying $2,000 a month out of their pocket on an investment property?
Well, the resilience of the consumer has been another massive surprise to us. And I think it basically comes down to a few things. One, that the unemployment rate has been so low that it's basically allowed people to keep paying back more than they'd like probably on their home, but it's allowed them to keep paying it back. We know Australians are really good at paying down housing debt. We have one of the highest levels of housing debt to income around the world. Household debt, which is mainly housing, is like 70% housing as well as other personal loans, relative to net disposable income is about 220% in Australia. At a peak, much higher than countries like the US, similar to countries like Canada, because they also have very expensive housing. But we are good at paying down our housing debt because of the things like the offset accounts. I think it helps people to build up their savings. I think also in this particular cycle, people did have a lot of accumulated savings built up over the pandemic, from the government handouts, from not being able to travel, from just buckling down and saving more. Bank of Mum and Dad has been a factor as well that's allowed people to enter the market at these expensive levels. And people make concessions. We've seen consumer spending volumes go negative for the majority of the last 6 quarters, for example. People have been making cutbacks on discretionary and essential spending, but they've still managed to pay down their housing debt. Not to say that there haven't been arrears, though. We have seen some increase in arrears in the bank books, but it's like 1 or 2% of the overall stock of loans. So it's not at levels where you'd be worried about it. At levels of 5%, you sort of start to get worried about levels of arrears. It's still at manageable levels, but there definitely has been some increase, and some households are absolutely doing it tough. And you can see that in some of the specific data that the Reserve Bank look at around the number of households that are in negative cash flow. On the Reserve Bank's own estimates, about 5% of households who are on variable interest rates are in negative cash flow. So there are absolutely pockets of households that are doing it incredibly tough. But on the aggregate, on the macro level, most households have managed to offset high levels of debt repayments with other concessions.
When are the interest rates coming? I think that's what many people would want to hear about.
Yeah, well, it's sort of it's been surprising that we haven't had rate cuts yet, I think, from the Reserve Bank. We were of the view that we would get some this year. I was certainly hoping for it for my own mortgage. But the resilience of the labour market has sort of allowed the Reserve Bank to keep pushing back this idea of rate cuts. Now, the markets at the moment are expecting the Reserve Bank to start cutting rates only in May next year, if not even a little bit later. So much more delayed than some of our global peers, like the US Federal Reserve was cutting in September. The Bank of Canada has cut, the Reserve Bank of New Zealand, the Bank of England, the Bank, the Eurozone Central Bank as well. So all of our peers are cutting interest rates, and the Reserve Bank is still worried about inflation here, that it's still too elevated. Our view is that we will get a rate cut in early 2025. We had been saying February, but it doesn't look as likely anymore. So early 2025, maybe the middle of next year, our view was that we'll get a few rate cuts next year, so maybe 3. Pretty slow start to the cutting cycle. But I think in the first half of next year, we will see the start of the Reserve Bank cutting rates.
So where do you think the rates will end up? Not just next year's rate cuts, but where will RBA be looking at?
I think in
landing?
the next few years, rates will probably settle at about 3%.
That's cash rate.
The cash rate, that's right. Yeah, so not the mortgage rate. So we're currently at 4.35%. So 3% cash rate, which means mortgage rates maybe 5% or so. I suppose, depending on the pass through of banks.
1.35 cut is what.
1.35, yeah.
Okay, 5 and below perhaps for owner-occupier debt.
Yeah, depends, I guess, on the pass-through rate and everything.
And would it be like by 2026, we are saying that we may get there?
Probably. That's the medium-term view. I mean, it is really hard to know. I mean, it's hard to forecast meeting by meeting, let alone the next few years. But the 3% level of interest rates is generally where we think neutral is in Australia, so where you're not putting too much upwards or downwards pressure on the economy. We see the current levels of interest rates as still being restrictive, so putting more downward pressure on the economy. And we think a 3% interest rate is more neutral, but it could be a little bit higher than that. So maybe we'll only see a few rate cuts in this cycle.
And then the cycle continues, then rates will rise again.
And then we have to see, where the cycle sort of takes us. I mean, it's likely that the global economy will face some sort of downward pressure in the next few years, and in that environment, maybe rates can go a little bit lower. That's more of a 5-year view, I'd say. We have had such strong performance in the global economy, US exceptionalism. I think that there is a chance that we do get a bit of a downturn, but that is more of a longer term view.
We've spoken a bit about the affordability crisis that we've had in this country. So what's being done or what can be done about making housing more affordable?
It's a really hard problem because basically when we say let's make housing more affordable, we're basically saying let's drop prices. That's the only way to make housing more affordable. There is no other solution to it. But if you're invested in housing, do you want prices to drop by 30%? I think the answer is no. If you're an investor who has a residential portfolio, you don't want prices to drop by 30%. The banks don't really want prices to drop by 30% either. So the solution here is really to stop home prices running above incomes for a long time, because the problem that we've had since 2000 really is that home price growth has run up so much more than incomes, which has led to the problem that we have now, that where home price to income ratios are just so high in Australia, and it makes housing unaffordable. So for the future, we basically need to build more. That's the main thing. We need to be building at least 250,000 homes in the next 5 years, at least every single year, to solve the imbalance between supply and demand. And I think longer term, that will be a big positive in keeping home price growth relative to income running at the same rate. Longer term, I think that we do need to potentially make some changes to our tax system around housing. So looking at whether to abolish stamp duty and bring in a land tax. Economists love talking about that because stamp duty is seen as it's a tax that is a disincentive for people to move. It's not a very efficient tax. And then also to potentially look at changes like restricting negative gearing, not to abolish it, but to restrict it potentially to 1 property, 2 properties, or to put a cap on the number of concessions that you're allowed, to potentially change some of the capital gains tax discount as well, maybe to restrict that. So I do think that there is a case to look at taxation, but it needs to be done in a broader context of overall tax reform in the country, because we also need to look at things like our GST.
But not that many people own more than 2 properties anyway, so would it even have any impact?
Yeah.
And interestingly, it's a lot of the times it's everyday mom and dads who actually own investment properties.
I've seen the data from the AT on that, which I think is really interesting. People think, everyone who does negative gearing are these rich Australians, but actually in the majority of the cases it's families with a family income of less than 200,000 for the family. So it's not, you might not be targeting sort of the right groups when you think about that. But that's why we need to do this sort of tax reform to actually see is the tax system currently fit for purpose in Australia, and can we make it better, and can some of the tax changes potentially help the affordability problem? Because I do think we have a lot of tax concessions on housing, and people often view it not housing as an investment, not often a place to live. And I don't know if that view needs to change, because in a lot of other countries around the world, housing is just seen as a basic right. You know, I need a home to live in. Whereas in Australia, we do tend to think about it as an investment.
Yeah, well, I guess hopefully, the government is able to find a middle ground with it, because it I guess the key thing that we hear from our clients is that, well, I'm buying now because I'm not really sure if my children or my future generations will actually be able to afford to buy a home for themselves. So they're actually shoring up or making it easier for their future generations.
But for the long term, that's not sustainable, because it's making inequality worse. And I think that will be a big problem in the election next year. We've seen that in a lot of other countries around the world, that these issues around inequality, very expensive assets, so not just share markets, but also things like housing, is a big problem for young people. And you have this disconnect between older generations now, like baby boomers, who have ridden a massive wave up in home prices, and younger people who are finding it incredibly difficult to get into the market. In the long term, it's not sustainable for Australia to keep going down this path.
I'm just curious. I know we have a huge shortage, but why has property been the thing in Australia, right? Like when we talk to clients, they're like, oh, that's the only thing in Australia that performs.
Well, if you look in the long run, housing and share markets have had the same rate of growth in Australia. So about 9% over a very long-term annual returns, both for capital and income, for share markets and for homes. And also it's the other discounts that we have, the capital gains discount, negative gearing, and the home in the pension test. We do have a lot of favourable tax treatments towards housing here.
And we have leverage, I guess, that you don't get generally with shares.
Well, you could use if you own shares for longer than 12 months, you can also apply the capital gains discount, or you can even do negative gearing on your share portfolio if you really want to, but it's usually seen in a housing sense, because people are also worried about the volatility in shares.
I was talking in context of, right, with housing, you can borrow 80% of the value of the property, but with shares, can you really leverage to the same level?
Yeah, true. Yeah.
Or
so
actually 95%, if not more, with property.
Yeah. And what that means is obviously if you have more exposure, you have more growth.
Yeah, that's right. Yeah.
If you're putting, say, 150K on shares versus on a 700K purchase, you probably make more money with property.
Yeah.
So it's compounding returns.
But thank you so much, Diana. It was wonderful having you. Thanks for making the time for us.
Sure. Thank you so much for having me.